AI is starting to change the way I think about money. Over the past few years, I've been focused on simple, long-term investing, and one strategy kept coming up again and again: investing in the S&P 500. If you don't know, the S&P 500 is basically a collection of the 500 biggest companies in the US. Instead of trying to pick the perfect stock, you're investing in all of them at once. It's called passive investing. And historically, it's been one of the most reliable ways to grow money over time, averaging around 8 to 10% per year. The idea is simple. Even if some companies fail, the overall market keeps growing, and over time, that growth compounds. Honestly, this strategy has worked extremely well for a lot of people, but recently, something made me rethink it. After looking deeper into AI and how fast things are changing, I started reviewing my own approach, and I realized things might not be as balanced as they seem. So in this video, I'm going to break down the key things I've started to question, and what I would do differently going forward. First, let's talk about the S&P 500 itself. Most people assume that when you invest in it, your money is spread evenly across hundreds of companies. But that's not really how it works. In reality, a huge portion of your money goes into just a handful of companies. The biggest names, companies like Apple, Microsoft, Amazon, Google, and a few others, dominate the index, and together, they make up a surprisingly large percentage of the entire fund. In fact, a significant chunk of your investment is concentrated in just the top 10 companies. And one company in particular, NVIDIA, has grown so fast that it now takes up a noticeable share on its own. Which raises an important question. Are you really diversified, or just heavily exposed to a few tech giants? This happens because the S&P 500 isn't evenly balanced. It's what's called a market cap weighted index, which basically means the bigger a company becomes, the more of your money goes into it. So, as certain companies grow in value, they automatically take up a larger portion of the fund. Now the real question is, why are these companies growing so fast? If you look closer, a pattern starts to appear. Many of the largest companies in the index are all heavily investing in the same thing: artificial intelligence. And at first, that sounds like a good thing. AI is growing fast. It's everywhere. So naturally, investors are excited. But here's where it gets interesting. For these companies to justify their current valuations, they would need to generate massive amounts of revenue in the future. We're talking about numbers so large that they go far beyond what these companies are making today. In other words, they're not being valued based on current performance, but on future expectations. And while that's not unusual in investing, it becomes risky when everything depends on one single trend. Because right now, many of these companies are making the same bet, that AI will continue growing at a massive scale, and they're investing heavily to stay ahead. In some cases, spending huge amounts of money to build infrastructure and expand as fast as possible. The problem is, a lot of this growth is being fueled by debt and complex financial structures that aren't always obvious. And when companies are deeply connected like this, their success becomes linked. So if one struggles, it can affect the others as well. What you end up with is a system where everything feeds into itself. Big companies attract more investment. That pushes their prices higher, which increases their weight in the index and brings in even more money. And because of that, even more money keeps flowing into these same companies, especially from passive investors like us. It creates a kind of chain reaction. The biggest companies keep growing, which makes the overall market look strong. And from the outside, everything seems fine. But if you look deeper, some analysts believe the situation isn't that simple. There's an argument that a lot of this growth is being driven specifically by AI-related spending, and without it, the economy might actually look much weaker. So this raises an interesting question. Instead of putting most of our money into the largest companies, What if we spread it evenly across all 500 companies in the index? Well, that option actually exists. It's called an equal weight S&P 500 fund. And on the surface, it sounds like a great idea. Instead of being heavily concentrated in a few big companies, your money is distributed more evenly. Each company gets roughly the same allocation, which means you're less exposed to the dominance of big tech and AI-driven growth. But here's the catch. This approach comes with its own trade-offs, because to keep everything balanced, the fund has to constantly adjust itself. And the way it does that can feel a bit counterintuitive. When a company starts growing rapidly, the fund actually sells part of it, and then takes that money and reallocates it into companies that haven't grown as much. So, in a way, you're reducing exposure to the winners and increasing exposure to weaker performers. On the other hand, a traditional S&P 500 fund works very differently. It doesn't fight momentum. When a company grows, it simply becomes a bigger part of the index. No constant rebalancing. No cutting winners short. It just naturally shifts over time. And that brings us to an important question. Which approach actually makes more sense? The more a fund trades, the more it costs. And that's something a lot of people don't think about. Those small costs might not seem like much at first, but over time, they can slowly reduce your overall returns. So even though I've slightly reduced my exposure to the S&P 500, I'm still keeping most of my portfolio in the traditional market cap weighted version. Because in the long run, simplicity and lower costs still matter. But now that I've freed up some capital, the real question is, where does that money go? And that brings me to the next shift in my strategy. I started thinking beyond just the US market, because we often assume that the US will continue to dominate, just because it has for the past decade. But what if that changes? What if the next 10 or 20 years look completely different? It might sound unlikely, but if you look at history, leadership in the global market has shifted many times before. The US hasn't always been number one. Different countries have taken the lead at different points in time, and the global market is constantly evolving. One way to think about it is like a pie made up of different countries. Each slice represents a part of the global economy, and over time, some slices grow larger, while others shrink. The total pie stays the same, but the balance inside it changes. And if that's true, then focusing on just one country might not be the safest long-term strategy. If we go back in time, there was a period when the United Kingdom was the dominant force in the global economy. London was the financial center of the world. British companies were leading global trade, and the influence of the UK stretched across multiple continents. At that time, it probably felt obvious that this dominance would continue for decades. If you were investing back then, focusing on the UK would have seemed like the safest bet. But history didn't play out that way, and we've seen similar patterns more than once. Take Japan as another example. In the late 20th century, Japanese companies were growing incredibly fast. They were leading in industries like automobiles, electronics, and technology. At the same time, the US economy was facing challenges: slower growth, higher inflation, and uncertainty. Many people believed that Japan would become the next global leader. And if you were investing during that period, it would have been very hard to bet against that trend. But once again, the outcome was different. The US recovered, and over time, it regained its position. And this highlights something important. The only constant in markets is change. Leadership shifts, economies evolve. These funds give you access, and no country stays on top forever. That's exactly why I don't want my entire portfolio tied to just one market, even one as strong as the US. Because when you focus only on the S&P 500, you're missing out on major global companies, businesses operating at a massive scale, driving innovation and growth around the world. And yet they're excluded simply because they're not based in the US. So the real question becomes, how do you actually invest globally in a simple way? One simple way to get global exposure is through a broad international index fund. Instead of investing in just one country, to thousands of companies around the world. We're talking about businesses across the US, Europe, Asia, and emerging markets, all in a single investment. Typically, these funds include several thousand companies spread across dozens of countries. So instead of trying to pick winners, you're participating in the global economy as a whole. Now, it's true that many global funds are still heavily weighted toward the US, and that makes sense because the US currently represents a large share of the global market. But here's the key difference. Over time, these funds automatically adjust. If one region starts growing faster, it gradually becomes a bigger part of the portfolio. And if another slows down, its weight decreases. So instead of trying to predict which country will win, you're allowing the market to rebalance itself. Another advantage is cost. Many of these global index funds have very low fees, which means more of your money stays invested and compounding over time. And if all of this sounds complicated, the good news is, it's actually quite simple to get started. Most investment platforms today offer easy access to globally diversified portfolios. Some even allow you to choose a level of risk that matches your goals. So instead of trying to manage everything manually, you can start with a simple structure and build from there. One idea that has always stuck with me is this: you don't build real wealth by following everyone else. You build it by getting in early, before something becomes obvious. And that's exactly how I'm thinking about AI right now. On one hand, I want to protect myself from potential risks, but on the other hand, I also want to understand where the real opportunities are. So instead of looking at the market randomly, I like to break it down into a few simple categories. Not perfectly, but in a way that helps me think clearly. The first one is what I'd call the crowded space. These are the biggest companies, with the most attention, and the highest valuations. Think major tech giants, companies that everyone already knows. The reason I call it crowded is because most of the money is already there, including passive investments. Then you have what I describe as the defensive side of the market. These are companies people rely on no matter what's happening in the economy. Businesses with stable demand, predictable earnings, and consistent cash flow. They're not always the cheapest, but they're often considered reliable. On the other end, there's the speculative side. These are companies driven mostly by hype and expectations. Their valuations are often based more on future potential than current performance. And while they can move fast, they also come with significant risk. Personally, I try to avoid this area because it often behaves more like momentum than long-term investing. And finally, there's what I consider the most interesting category: the overlooked space. These are companies that aren't getting as much attention right now, but could benefit significantly from long-term trends, especially when it comes to AI. Let me explain what I mean. Right now, many of the biggest companies are competing in the same way. They're spending massive amounts of money trying to build the most advanced AI models. The assumption is simple: whoever builds the best technology wins. But what if that's not how this plays out? Because something interesting is starting to happen. A lot of smaller and mid-sized companies are taking a completely different approach. Instead of building their own AI, they're integrating multiple models into their platforms, giving users the ability to choose. And that changes everything. Because now, it's not just about which model is the best. It's about which one is good enough and makes the most sense for the user. And when tools become similar in performance, price starts to matter more, which can lead to competition and eventually pricing pressure. And that's great for users, but not always great for the companies spending billions trying to stay ahead. Think about it like this: if two products solve the same problem, most people won't choose the most expensive option. They'll choose the one that's good enough at a better price. And that's the key idea. When a technology becomes widely available and easy to use, The advantage doesn't always stay with the companies that built it. It often shifts to the companies that use it most effectively. And that's exactly why I'm paying more attention to smaller businesses. Because they don't need to win the AI arms race. They just need to use the tools better. They don't need to build the technology themselves. They just need to apply it to real problems in a smarter and more efficient way. That's why I'm starting to look more closely at smaller and mid-sized companies. Not because they're guaranteed to win, but because they have room to grow. And here's how I see it. If I'm wrong, the downside is limited. But if I'm right, the upside could be significant. Now, this brings me to another shift in my thinking. One thing people often underestimate is that major technological changes don't just create opportunity. They also create uncertainty. Because AI isn't only affecting companies, it's influencing how systems work, how decisions are made, and how trust is built. And when systems start to change, it's natural to think about stability. That's why I've started paying more attention to assets that have historically been used as a store of value. One example is gold. If you look at long-term trends, central banks around the world have been increasing their gold holdings. And in recent years, that trend has accelerated. Which raises an interesting question. Why would large institutions be increasing exposure to something like gold at a time when technology is advancing so quickly? One possible explanation is that it acts as a form of stability during periods of uncertainty, especially when global systems are evolving and the future becomes harder to predict. And this isn't about replacing one system with another. It's about understanding how different parts of the system interact and making sure you're not relying on just one outcome. So why are we seeing more attention around gold? There are a few reasons. One of them is how institutions are starting to view it. In recent years, gold has been treated more seriously as a reserve asset, something that can be used to balance risk in uncertain environments. And that shift in perception matters, because when large institutions adjust how they allocate capital, it can influence demand over time. Another factor is simple: supply. Gold is a limited resource. It can't be created on demand. So when demand increases, it tends to put pressure on price. Now, I'm not here to make bold predictions about where gold is going next, because no one can say that with certainty. But I do think it plays a role in a balanced strategy, not as a way to get rich quickly, but as a form of stability, something that can help offset risk when other parts of the system become unpredictable. So the real question becomes, how do you approach something like this? Personally, I like to keep it simple. One approach is holding physical assets, not because it generates income, but because it represents something tangible. Another approach is using financial instruments that track the price of gold, which makes it easier to manage, adjust, and build over time. The key idea isn't timing the market perfectly, but gradually building exposure in a controlled way. And just to be clear, this isn't about going all in. It's about balance, making sure your strategy isn't dependent on a single outcome. For me, this isn't about making extreme moves. It's about balance, allocating a small portion of a portfolio to something more stable, while still staying invested in growth. And that brings me to one of the most important points: making sure you're never forced to sell. Because one of the biggest mistakes people make when they start investing isn't picking the wrong assets. It's not having enough liquidity, not having a financial buffer for unexpected situations. And when something happens, they're forced to sell their investments at the worst possible time. That's what really destroys long-term progress. That's why I've been thinking more about cash, not as an investment, but as flexibility. Having reserves gives you options. It gives you time, and most importantly, it allows you to stay in control when markets become unpredictable. Because markets don't move in a straight line, corrections happen, downturns happen. That's part of the system. But if you're prepared, those moments can become opportunities instead of problems. And that's really the bigger picture here. AI is changing a lot of things. It's creating new opportunities, but also new risks. And instead of trying to predict everything perfectly, I think it makes more sense to stay flexible, to stay balanced, and to build a strategy that can handle different outcomes. Because in the end, it's not about being right all the time. It's about being prepared. This is super important because cash is king during a stock market crash. My honest thoughts, light groovy music. I've seen way too many people wait years for a market drop and miss out on massive gains in the process. That's why my strategy is simple. I'm still going to keep putting most of my money into the S&P 500 so that if AI continues driving growth, I'm invested in the businesses leading that change. But to protect myself from a potential AI bubble, I'm also diversifying into the global markets, small and mid-cap stocks, gold, and cash, because the truth is, nobody knows what the market will do next. So instead of trying to predict it, I'm preparing for both outcomes. If you want to learn exactly how to invest for beginners step by step, then I'm going to leave that video right up there. But don't click on it just yet. Make sure to subscribe if you want to grow your wealth, okay? Clicking tongue. I'll see you over there.